because I'm happy to post them all. I think we've had some really good discussion. And I'm glad you're all there. Is Leslie on yet?
Yes, I am, but my camera is disabled.
Oh, Paul, can you please enable my friend Leslie's camera?
I've done. So
Wonderful.
you can turn it on.
Okay, and we'll get started. I think so. We have until 12:15 your time. So we have an hour and 15 minutes. That's good. And Brindusa, Paul, just so you know, Brindusa has to leave everybody after a half hour because she has an important appointment that she can't miss. So Brindusa, I'll try to get to your second round before if we can.
That sounds good. Let's see how the conversation goes.
Exactly. Hi, Les.
Hello.
How are you?
Very well, thank you. How is everyone?
Great.
Yeah.
Hi, Les.
Hello, Simon. Good to see you after a very long time.
I feel like all my friends are on this panel.
Yeah.
So
Indeed.
Leslie, it's great to see you too. I miss you, Leslie.
Yeah, we miss you too.
I should say,
okay.
Jennifer, while we're friends, you're also one of my bosses, so board members.
I'm actually kind of the boss of a couple of you. So
Okay.
I used to be the boss of another one. So, by the way, producer, you wanted to try to use the slide, right?
It's just an image, actually. It's not. I mean, it looks like a slide, but it's an image.
So you'll share your screen at that point. Is that it?
I could do that, yeah, if you want.
Okay, Paul, does that work?
Yes, that works. Everybody has their setting that can share the screen. So
Okay, so bring then. That's good. Okay, let's give it another minute. I don't know, or should we get started? Let's give it another minute for people to call in, and then we'll get started. I think the most important thing is that this is being taped, so I think a lot of people will watch it afterwards as well. See, people are just calling in. We had quite a lot of people yesterday, actually. It's just hard with these virtual events because it's like you jump in, you jump out.
Yeah.
And they don't flow like from one into the other because they left enough time in between.
I think we all got used to that, didn't we?
I know. I'm trying to like forget the virtual like COVID time.
Yeah, we consume knowledge on demand, don't we?
That's true too. Exactly. I mean, that's the thing. I'd say like the most important thing about this discussion is that it'll be available for a long time afterwards. Okay, Paul, why don't we get started since it's a minute after, and then people will call in as they call in. Do you want to make any first opening remarks, or do you want me to just jump right in?
Yes, certainly. Good morning, good afternoon to everyone, depending on where you're joining us from. You're welcome again to the day 2 of the Global Economic Ideas Festival, GEIF for short, which is brought to you by the ICCE, the Institute of Certified Chartered Economists, in partnership with the Young Global Economic Society. So the ICC is a global professional body that is providing certification in the economics field. So we provide what we call the Chartered Economic Designation. We are membership-based, a globally membership-based organization that we have economists from all over the world that are part of the ICCE. And as part of the things that we do is to create platform for dialogue, for conversation, just like the GEIF. And so the GEIF has been instituted as the annual global conference of the ICCE. We did our first edition last year, and this year we're doing a second edition, all virtual. We're hoping to progress to an in-person session in the coming years as we build our capacity and momentum. And so we began yesterday with a couple of sessions, and today is the final day of GEIF 2023, where we have 2 more sessions to go. The first session being this very one, and then we have our second and last session for the year for the GEIF in the next session. So we're very much grateful for everyone for joining. In the course of the conversation, of course, I will be putting some links there to the ICC website. Of course, if you join this session, it means that you'll receive a couple of emails from us, and There are relevant links there that can help you understand more about the ICC and how you can be part of the ICC. And this is not the only thing that we do. We have other programs that we're posting from every now and then that are very relevant to all economies and, of course, aspiring economies. So you want to take advantage of it and be part of what we are doing to build your capacity to network yourself globally as well. So today, we are very excited to begin with a very important session. And of course, we have our very own Jennifer Blanque, who is a co-chair of GEIF, and it's been very instrumental. I haven't thanked her enough yet for amazing job that she's done leading to GEIF 2023, and of course, all the work that she's been doing since the whole festival started yesterday. So Jennifer, we're very much ready to zoom into the conversation for today. So I'll hand over to you now. Thank you.
Excellent. Thanks so much, Paul. And I am delighted to be here for day 2. And it is a great topic, I think, that we're kicking off on with today, SDG and climate financing and how you can step up climate finance actions to build a sustainable future. And just to say, I think the topic today is a bit broader than sustainable finance. It's really about sustainable finance and development finance and how these things can build the sort of future that we want, which is both sustainable and human-centered. And so, just to kind of put things in context, and what I want to do is then, introduce our incredible panel. There's an ongoing battle against climate change. And as we're trying to sort of pursue sustainable and equitable development, climate and development financing really both have critical roles to play. I think climate finance gets a huge amount of attention now, in particular, but it's really how you blend both of them to do the things that we know are needed. And so mobilizing resources for priorities like sustainable agriculture and sanitation and addressing climate-related vulnerabilities in developing nations can really drive progress towards the SDGs more globally while mitigating the impacts of climate change. And to do this effectively, what is needed are really innovative financing models, the right policy incentives, and international collaboration so that we can really accelerate the transition to the more equitable and sustainable world that I think we all really want to achieve. Today, we have a stellar panel of experts to help us navigate the steps and the actionable steps that are needed to step up both the financing and the action to drive meaningful change. So let me introduce them. I think, first of all, Brindusa Burrows, who's holds many hats, but she's, among other things, visiting lecturer at the Geneva Graduate Institute for International and Development Studies and focuses a lot on financing the SDGs there. Leslie Ndlovu, the CEO of ARC Limited, and they're providing, insurance solutions in Africa, and we'll hear about some of that work. Dominic O'Neill, who's the executive director of the Sanitation and Hygiene Fund, which sort of speaks for itself, but we'll hear more about the important work there. And finally, Simon Winter, the executive director of the Syngenta Foundation for Sustainable Agriculture. What I'm going to do is I'm going to ask each of the panelists, we'll do sort of 2 rounds of questions to sort of dig down into the topic. And then what I'll do at the end is open it up for questions. There's a place where you can sort of write in your questions if you have any, and we will see them. And we'll try to, take some time at the end to really have an interactive discussion. I want to say also to the panel, if any of you want to react to what you hear, obviously, from the other panelists, that would be great, because I would love for this to be a very interactive discussion. So Brindusa, let me start with you. You've worked a lot on financing the SDGs, and we've seen from recent analysis that not only are we not achieving most of the SDGs, but the world is actually backpedaling on several of them. What needs to happen in the development finance space to reverse this very depressing trend? Brindusa.
Well, thank you for addressing me the most depressing question of all.
Well, you're so optimistic. I figure you'll bring in a little bit of positivity.
I get to pick that one. Thank you so much for having me today. I wanted to say that you mentioned I have many hats. One of the other hats that is informing a lot of the things that I know about the space is that I founded about 8 years ago a company called Ground Up Project. We were very involved and still are involved in generating deal flow and finding deal flow in environmental social space in the emerging markets primarily. So a lot of what I've learned is really firsthand from engaging with investors and entrepreneurs on the ground. Today, I'm very grateful to be able to lecturing at the Graduate Institute, because the academic hat maybe gives me a little bit more freedom to comment on some of the things that I see. And I wanted to, before I answer your question, I just wanted to share with you a picture. You mentioned the depressing state. I hope you're seeing this. It's the pretty picture that everyone knows, right? It's beautiful. It's very lovely design. The designs get better every year, but this is the reality. The reality is that everything you see in this picture is actually going wrong. And of the 140 targets that can be measured in the SDGs, only half show moderate, actually half show moderate or severe deviations from the desired trajectory. And more than 30% of these targets have experienced no progress, even worse regression below the 2015 baseline. Right? How bad is that? And I wanted you to see the picture because the colors, I think, can be imprinted in your memory much better than the numbers can.
So all that's on target is the green part.
Yes, all that is on target is the green part.
So the goal 1, goal 16, goal 8, goal 6, nothing's been done.
There you go. And then the yellow tells you fair progress, but acceleration needed. What's more worrisome is that red actually means stagnation or regression, right? And so to me, this is pretty much screaming, for help at this point. There we go. I won't bore you with slides. So that was just to sort of get it going. Post-pandemic, the numbers on how much we actually need to solve these challenges was bumped up to 4 trillion. It used to be something around 3 trillion. We need $4 trillion annually to sort of cover all the challenges that were on the slide, on the image that I showed you. To put that in perspective, the global capital markets today are around $83 trillion. So in principle, we're talking about a realizable amount. But I think the difference there is when you start to look at what's behind the numbers, sustainable finance, sustainable investing in general is estimated today at around 1 trillion assets under management, $1 trillion US. This encompasses everything that we call ESG, exclusions, everything that on a spectrum is actually safeguarding us from harm. So, do no harm, do not engage in things that are creating more harm. What this is not doing is actually pushing for real impact. So you want to have positive net value as opposed to just defending from things that could be potentially harmful. And so out of that, and most people refer to the numbers, although it's really difficult to get an accurate picture, but out of that, you have probably about, by best estimates, $33 billion of assets under management in what we call the impact industry. Okay, and I want to tell you, the cat food industry is worth $34 billion. Yeah, and I did say cat food industry, okay? So it just gives us a sense of just how, and impact investing, meaning investing for positive impact, has been around since 2001. It is impossible that we have at this point such little progress. And one of the things, and I'm gonna perhaps let the other speakers get into the financing mechanisms and what they see, because we have here on the panel very specific thematics. But the last thing I want to say as a generic introduction is that in both development finance and in private finance, it was just a week ago, I think, maybe a little bit more than that, Convergence has issued the latest State of Blended Finance report. And by the way, they decided to actually start issuing this twice a year because it's equally grim. But we have seen a 40% drop in deal volume, in blended finance, and the 55% decrease in climate blended finance. And the report, you can get into details, but the report shows you that private finance that's been leveraged by development finance is actually now lower than it was before 2015. So obviously this is motivated by a global context. But obviously there's something behind there that is fundamentally wrong, and we need a more radical conversation about some of these drivers. For me, one of the things we hear a lot in development finance is the issue of additionality, finance additionality. So could I find investments where my money would not have otherwise been pulled, private investment that otherwise would not have been brought into these investments. But there are two things behind that, and I do hope that one day we can have an honest conversation about them. One is that in most of the emerging markets where the SDGs are badly needed, you have an issue of finding business models. Making companies derive income and profit, making them investable in that sense is really a challenge. And the question is, does a business model for survival, for impact, for life, does a business model of this way have to be perceived, measured, quantified in the same way? Can we expect the same risk and return equation on an SDG focused investment? And the second the second issue to that is that there are private investors that have impossible risk and return requirements when it comes to some of these SDGs. So I do think that we need to reconsider a little bit our systems in that regard, especially in the development finance world, additionality, but also this drive to derive a return can be real major barriers in actually deploying more funding, and especially in leveraging more private funding. And we see a lot of the, perhaps you will talk more about this, crowding out private investment instead of crowding in private investment. So I'll leave it at this for now. I see everyone nodding, so I'm really looking forward to hearing your other opinions.
Thanks a lot, Brendusa. I mean, I think that really puts everything in context. We're going to try to build up, in a positive direction from here. But, we had an excellent conversation yesterday during the finance, the sort of global finance discussion. And Sarah Jari, who's worked in impact investment for years, was cautioning about some of the things you say. But frankly, when you say 33 billion in impact investment right now, 34 billion in cat food, I think these are the numbers that we need to understand, because these other priorities that we're setting as a society. I love cats. I'm nothing against
one too.
But there's a real issue here. So, thanks for letting us understand, how big the challenge is. And I think it's really important for us to be aware of that, because unless we understand how bad things are and how difficult it is, it's hard to build forward. Now, I also want to focus on the fact that you're talking about investment. These are investments for us as a society. So what are the returns? The returns are going to be the returns to the investors, but also the returns to society. So positive externalities. And how do we start, sort of understanding how important that is for us, and maybe thinking, in intergenerational terms, about what is needed, both today, but also in the future. A lot of us have children. A lot of us at least worry about other people's children and grandchildren. So, thanks for sort of setting the challenge in front of us. And so with that, Simon, I'd like to turn to you to talk about let's move to a more constructive, what can we actually do about it? You focus at the foundation, especially on sustainable agriculture as a driver of development. You're seeing actually some really interesting progress happening there. Can you tell us, how development finance and climate finance in particular are making a difference in the work that you are doing, particularly for smallholders in Africa, South Asia?
Thanks, Jennifer. Yes. So we're at the Syngenta Foundation for Sustainable Agriculture, very focused on those what we call pre-commercial smallholder farmers. So those who are not yet operating, generating commercial returns from their farms. And we're working with them mostly through intermediary organizations, especially local SMMEs, in order to help them access the technologies and services and markets that can help them shift from low and volatile production that doesn't generate commercial returns to becoming successful commercial farmers, albeit at a small scale. So finance plays a critical role. And we definitely have seen some progress, I would say, on the development finance side. So if we think about what the farmers themselves need in terms of finance, for a long time, microfinance was not getting into rural areas. It was staying very much in the peer group lending models in urban communities where you had sufficient density and reachability, let's say, into those communities that you could get those MFI models working. But we have seen with organizations like BRAC in Bangladesh and now in about a dozen other countries, which is a partner of ours, that microfinance for small-scale farming is starting to flow. Still a lot to be done, but that is moving forward. If we move up the scale a little bit to the SMMEs that are then the off-takers or input suppliers or other partners with these farmers, helping to process their produce, for example, and so on. Again, we have seen some progress in, let's say, the SMME banking space, and in particular, the impact of social lenders like Root Capital, for example, who target the cooperatives and these aggregator enterprises. We're starting to see increased flows of capital happening in that space to a modest level, and addressing the challenges around the capacity building and the de-risking in order to enable that sort of finance to flow is also starting to be addressed. I want to call out, for example, Aceli Africa, led by Brian Mulder, who used to work at Root Capital, which is providing the ability to help banks reach into these target markets, and at the same time building the capacity of the borrowers, to be more effective customers. We're also seeing the growth of impact venture funds, but here I come back to Binta, to your observation as well, that I think that sort of happened for a while, and I think it's kind of gone off the boil a bit, probably for many of the reasons you alluded to, and they those types of vehicles have been supported with first loss guarantees or other sorts of de-risking facilities. But still, you get this gap, as you correctly observed, between the fact that there is, on the one hand, lots of impactful enterprises that are not yet mature enough to be considered good deal flow for those kinds of structures, and then the lenders or investors who say, well, we don't know how to do these kinds of transactions. So I would say that's got a big question mark still over it, and whether that is really a sustainable and scalable model. And we see this particularly from our perspective as we look at agricultural technology startups that could be offering an array of either digital-based services or the kinds of machinery or other types of technologies that could be used productively by smallholder farmers. But those enterprises often don't have the evidence from working with the emerging commercial farmers to present to investors or to present to lenders to convince them this is actually a market worth financing. Moving across to the, just one general observation as well around development finance. I mean, there are many different types of development finance. I've touched on some that are relevant to our agenda. Sitting behind this often are the development finance institutions that either the IFC or its regional development bank equivalents or national DFIs like FMO out of the Netherlands and so on. My observation after many, many years of working in this space is that although these are supposedly development finance institutions that are supposed to be taking a lot of risk, because the whole point is to enhance development, they actually don't usually. They tend to adopt a sort of herd mentality, looking very closely at what each other's doing, not really wanting to step outside. And as a catalytic organization like ourselves that's trying to cross this bridge between finance and those who need the finance, particularly in very high risk environments, it's incredibly frustrating to work with these organizations. And we've had a recent experience of this with one of them, where you can spend 18 months putting what you think is a really innovative and high impact transaction together, and then at the last minute there's a board decision or a board review, and they say, no, sorry, not going to work on it anymore. And the amount of effort and the amount of capacity that goes into trying to do something that's innovative, and then getting disappointed after that kind of transaction, time and effort, is extremely frustrating. So we need different models, and we can come to that a bit later in the discussion about what they might be. Shifting over to the climate finance side, I would say for our target smallholder farmers, not so much yet. I think it's starting to come in some areas. Agroforestry is one area where we're starting to see funds flow, where you can use remote technologies to, at a very cost-effective price point, observe and verify that the trees are actually growing as they're supposed to. And Rabobank's Acorn initiative is one pioneer in this space that is moving money into smallholder farms. But there are relatively few. There's a lot of complexities in this, and maybe Jennifer, a bit later in the discussion, we can touch on what might be some solutions to those complexities. But at the moment, on the climate finance side, we're seeing most money still flowing into mitigation type investments, which could be things like clean energy, renewable energy, and forestry rather than agroforestry. But where it comes to the smallholder farmers, we're really struggling to see that. And even on the commercial scale, we're still seeing challenges. Verra, for example, one of the main climate verification agencies, recently suspended a lot of their agriculture verification work because they were getting challenged about the validation of the actual results of what they had been certifying, and so on. So it's a very tricky space as far as agriculture and climate is concerned. Maybe I'll pause there, Jennifer.
Thanks a lot, Simon. I mean, again, there's so much good work going on, but then to scale it, how do you get the funding in? I know that when I was at the African Development Bank, I would get quite frustrated trying to figure out because people are looking for big bankable projects. How do you find a big bankable project in some of these areas? Whether it's agriculture, whether it's, well, sanitation, hygiene, a little easier if it's on like the big sanitation side, but if it's on more the SME side, very, very difficult. And I mean, that's one of the things I think that Brendusa's really been trying to work on. And if the DFIs aren't the ones who are going to take the risk, who, right? What is their role then, honestly? So I think that is something definitely for us to kind of, hold. Brendusa, I know you're going to have to run. I just wanted to come back to you quickly before you go, and then you can stay until you really have to go. In case there's anything you want to quickly say before then, Dominic, I'll come to you afterwards to hear about the sector that you focus on. Brendusa?
Thank you. Just a couple of thoughts. And thank you, Simon, for mentioning this. And I hear your pain. I've seen this in other sectors as well. Two things that for me are quite important at this point. One is that we can and we should continue to work through all the mechanisms that are available. We have had in the past 20 years amazing creativity in trying to work through the system and trying to navigate it and trying to design new tools that match the ways in which we can sort of reduce this between investor requirements and then bankable projects on the ground. So getting more stuff funded actually has to come through narrowing that gap, and we should continue to do that. But we actually need to also, in that moment, start to think a bit about, take a step back and have a radical discussion about whether the system still serves the purpose, right? And what do we still consider risk and return? Do we really assess properly in all our numbers risk to life? At the moment, our life systems are in danger, and the kinds of risk we measure are quite well far off, I think, from the concept of how fundamental this is, and it equally in terms of returns, right? Microfinance industry has survived and thrived in the past couple of years because the global economy was wrong, was going bad. So, when you had a -1 return, on interest, they were able to provide you a 2 or 3 or 4%. Is that really? I mean, this is great, but is that really the kind of thriving model. So that's the first thing. And the second thing I want to say is that I've seen over and over the Silicon Valley model of type of investment trying to be applied in these SDG space. And I think we need to stop kidding ourselves. This is not a model that you want to apply. I think we want to learn from local communities. We want to learn from local money. And the definition, once you're on the ground and you work with people on the ground, the definition of risk and return changes fundamentally sometimes. And you have channels and you have ways of valuing money and the bankability of projects that are different. And it's funny, just before the session, I saw a cartoon from the New Yorker. This is like the front office of a gym. And it says, our mission is to make you value your body, but not so much that you stop coming, to the gym. And I feel like it really sounds a little bit like the finance industry at the moment, and we kind of need to ask ourselves, some serious questions about that. And thank you. I didn't mean to stir the pot, but I do think that at some point we have to really ask ourselves that question, and we owe it to all the people who are really trying to work through mechanisms and inventing and finding new ways to deal with day to day.
Great, thanks, Medusa. And I think please do stir the pot, because this is the Economic Ideas Festival. I mean, the whole idea here is that we're talking about more human-centered topics, I guess planet-centered topics. And I think understanding, and this came up again a couple of times yesterday, that we need new models. I mean, we need to kind of, I'm not saying break it and rebuild it, but there is a certain aspect of that in the conversations we're having, because otherwise we will keep limping along and tapping ourselves on the back that we're doing something, and yet so many people still living in poverty, and yet the planet's still burning down, and yet that terrible image that you showed us in the beginning. So thank you for that, and stay as long as you can, and it's been so great having you on the panel. We'll continue then. Thank you for, I think you've it's good that you've stirred the pot. We will continue kind of trying to make the soup for the rest of the discussion. Thanks. Dominic, I'd love to come to you now. You focus on another sector that I think often is neglected and yet so incredibly important for development, and the climate, and environment in general, which is the sanitation and hygiene sector, really overlooked among the areas supported by development finance. It's not like the first thing they think of, right? What makes it so compelling? Sell us your sector.
It was a pitch. Well, thanks. And you really want to echo things and core messages from what Brendusa and Simon have said. A lot of their experiences are borne out in our work. Our job is to stir the pot. And apologies for the sanitation pun there, but there is a global failure. In your graph there, Brendusa, I think it was SDG 6, that was one of the most off-track SDGs. It's been overlooked, badly underfinanced and badly financed for decades now. So I'm I run the Sanitation and Hygiene Fund. We were set up 2 years ago, and our mission was to change that. It was to catalyze new ways of financing sanitation, hygiene, and menstrual health. And so the first question we had was, how do we value these things? Not just from an emotional human perspective, and I'm talking to the economists on the call, how are you as economists valuing sanitation, hygiene, and menstrual health? What are not just the direct, obvious benefits of having access to safely managed sanitation? What are all of the externalities? What does it mean for school children, for people in workplaces, to not have access to these essential core life services? There are 3.6 billion people without access to safely managed sanitation. So that 3.6 people who don't have access to a toilet that is safe, that they can wash their hands in. And that doesn't mean that 3.6 billion people alone are infected. You can easily double that, because if you can imagine, if they don't have a safely managed toilet, then they are going somewhere. And actually, the big urban development in the story of cholera, John Snow in London, was when they learned how to manage sanitation. That was a catalyst for making London in the UK and other municipalities livable spaces, and allowed it to become, and other cities to become what they are today. So the first question I would put to the economists to get them thinking is, how are we valuing it? There are figures, one released yesterday in a report from The Economist, that $1 of investment in water, sanitation and hygiene will lead to a $7 economic return. But capturing those in terms of investment proposals is difficult because the links are complex, but that's the estimate that would be that's been made. But in terms of that value, nowhere is it captured on anybody's balance sheet the impact on reduced health costs, on improved education outcomes, improved productivity, reduced lost days of work. None of that is captured in hardcore investment decisions. And if it's not being counted, it's not being valued, you can't include that in your investment proposal. The second question, which isn't necessarily for economists, more for the financiers, is once we've worked out how to value sanitation, how are we going to finance it? The current model, and I'm thinking in particular in the global development context of those countries at the base of the pyramid, the most vulnerable, the weakest areas, most fragile. The current model for financing these is completely inadequate. There are countries that we're operating in that have, a population of 400,000 and an annual public sector budget of $5,000 a year for sanitation. So the current models, both of financing and also how it's delivered, are quite frankly outdated. And Simon, the agricultural sector has been through this transformation. I know it's still a work in progress, but you've been able to engage private sector to build SMEs and to help the financing institutions understand how can we engage and support them. And that's a sort of catalytic transformation we're looking for in the sanitation economy. Now, we've heard the value of the cat economy, or the cat food economy, sorry. I don't think there's a cat economy. But the value of the Indian sanitation economy is estimated to be between 60 and 90 billion. It depends how you calculate it. But that's the value that we believe is captured in these economies. And that means in terms of the potential for goods and services, for revenue streams, for employment, and ultimately for better, safer sanitation services. So what we've been doing is, in the Sanitation Hygiene Fund, is not asking, how do we build 3.6 billion toilets or however many you need to service that? It's how do we finance those, and how do we build the sanitation economies that will deliver the goods and services and the sustainable financial flows that are required to deliver properly and safely managed sanitation. In doing that, we are able to capture the externalities in terms of the jobs that can be created, the SMEs that can be created, the economic value in those SMEs, providing goods and services. And we're going to talk about market maturity, I think, later in the session, but that's key in terms of how do we increase the maturity of the market so that there can be more jobs, more sustainable financing. The benefit of this paradigm shift in terms of a very old-style development paradigm to a new alternative financing mechanism is that we believe will drive the innovation as well, the technical innovation and the financial innovations. We're also working on menstrual hygiene. And again, there's hundreds of thousands of women, girls, and menstruators each day do not have access to the goods and services, to the products, and to a safe place to manage the menstrual hygiene each day. And that, quite frankly, again, is a failure in the value chain. That outcome, that service has not been valued, and so it hasn't been invested in. We're looking at that. I'll talk about that more in the marketplace, but again, it's about a different financing paradigm as to how we can deal with what is essentially a market failure. So although, and I know Brendusa is very concerned about the lack of finance, but we see it as an opportunity. We know that the ODA, the official development assistance, you know, the money that USAID and the other bilateral donors that we're all very familiar with and has driven the sort of the development paradigm until today, that money is now capped. It's probably maxed out as a proportion of available development finance. The future, whether people like it or not, and that's why this call with the economists is so important, is in more investment-based decisions. And to Brindusa's point, the returns in these investments are going to, the financial returns are going to be marginal. We're not saying that these sectors are all hidden telecommunications sector where you're going to get 10%, 20% returns. The financial returns are marginal. We're not suggesting they are anything but the social impact returns, all of the externalities, that is what we need to value, to count, and to invest in. I do want to touch briefly, Jennifer, allow me, on carbon, because we've looked at this closely, particularly in the sanitation sector. We know that unsafely managed sanitation is a very high emitter of methane. We haven't been able to comply with the carbon credit requirements for verification to be able to access that form of climate finance. But there are definitely opportunities there in the future. But also, as you can imagine, any sanitation scheme is very vulnerable to climate change. And we need climate resilient infrastructure and systems so that if there is a storm, or if there is a drought, if there is flooding, that the sanitation schemes are still standing afterwards, and that when there is a flood episode, that it doesn't lead to cholera outbreaks, which are all too common. So there's a lot of both. There's an interesting discussion around climate mitigation, carbon containment, but also about climate resilience. And again, just to echo Brindusa's final point, all of this, in our view, there is a role for a small role for international finance, but we're targeting national development banks and the local financial institutions. This has to be financed locally. There's no way the SMEs we're looking at can exist on, servicing US dollar debt. It's just not possible. And that's where the ODA, the development assistance, can be used to de-risk those investments and to give them a fighting chance to get a good foothold. I'll park it there, Jennifer, if that's okay.
Yes, thanks so much, Dominic. And I think just a few things, particularly for if there's anybody who's listening in who's thinking about a project, maybe master's thesis or PhD thesis. I think there's a lot of work to be done here. You talked about the sanitation hygiene economy, similar to what has been done in the past in the travel and tourism economy, for example, just making the point that travel and tourism, its impact is not only about the people who come and maybe even the airline tickets, but it's about how people, sort of contribute to more generally going to restaurants and the food and bev and everything. That sanitation hygiene, very similar. It really does impact many other aspects. And that this is a big business also in advanced economies, right? I mean, there's a lot to be done, and there's a lot of jobs there. There's a lot of revenue there. So these are things important. And the last thing I just say on that is, I think about sanitation and hygiene a lot the same way I think about nutrition, which is that if you don't get it right, a lot of the investment, particularly development investment that you're putting into other things, is wasted, because if kids have diarrhea, but you're trying to get them nutrition, I mean, that just doesn't help. Right. So I think there's a lot in there to unpack, and super important. And I agree, great business opportunity. And I look forward to hearing a little bit more from you afterwards on menstrual health and hygiene, which I think is even the more underlooked. It's like the underlooked of the underlooked. So we'll come back in a second to that. So with that, I'd love to shift to you, Leslie. It's a little bit of a different approach. So it's not so much a sectoral approach, but thinking about financial innovations that are extremely important for sort of driving the sort of future that we want. When people think about climate action or development action, the role of the insurance industry, or insurance in general, is quite overlooked. How can it make a difference, and why is it that although it's such a critical driver of better sustainability, why is the uptake in Africa so low? Leslie.
Thank you very much for that. One of the advantages of coming in last is that there are a lot of good points that have been made by my co-panelists. So maybe just to start by talking a little bit about who we are at the African Risk Capacity and what problem we are trying to solve. So the African Risk Capacity arc is unique in the sense that we have a political mandate from the African Union to design, create, and implement risk transfer solutions, or more plainly, insurance solutions all across the African continent. This is in response to the increasing frequency and severity of natural disasters. So our insurance programs cover droughts, floods, and tropical cyclones, which are the most prevalent weather-related risks on the African continent. We are operating across three major client segments. We provide insurance, firstly, to governments, so at the macro level, as it's sometimes referred to. In this case, the insured would be the government. If there is an extreme weather event, a drought, a flood, a tropical cyclone in a country, we pay the claim then to the government, and the government then launches relief efforts. We also provide insurance to humanitarian agencies. Think about the World Food Programme, the International Red Cross, because this type of organizations have to scale up their activities in the aftermath of a natural disaster. We also then, in our third segment, provide micro and meso insurance and reinsurance to really support small to medium scale farmers all across Africa. And this is where our work overlaps with what Simon was describing at the level of the Syngenta Foundation. Then we are a highly rated financial institution, so rated A- from a financial strength standpoint, and rated #1 from an ESG standpoint by Sustainalytics. And all this, I think, is important for us because we have, on the one hand, the credibility of a well-regulated financial institution alongside the political mandate of a public institution. And this is really essential to our business model. On the SDGs, I think, as has already been mentioned, maybe to touch on really quickly on that, we are focused on 5 SDGs, SDG 1, end to poverty, SDG 2, zero hunger, SDG 5, gender equality, SDG 13 on climate change, and of course, SDG 17 on partnerships, because really what we do only works at scale and in collaboration with others. Our ambition, coming to your question, Jennifer, is really to provide insurance solutions to the 700 million people on the African continent whose lives and livelihoods are at risk as a result of extreme weather events. Insurance is a business of scale and diversification. By scale, we mean having enough premiums that are coming in to comfortably pay all the claims that arise, as well as have adequate revenues to pay all the expenses that come with managing an insurance business. Diversification in the sense that while climate risks in any one country are quite high, when you aggregate them on the scale of the continent, it's actually quite low because there's always something happening, but it's not happening every time, everywhere, meaning that you can use the revenues that you're generating to pay for the claims in the countries where they're happening. So really, insurance is about generating this scale and diversification, and that's how you make all this sustainable in the long run. To achieve this, as has already been mentioned by my co-panelists, we really need to crowd in the private sector. The problem cannot be solved by the public sector alone. On the private sector, we're looking at really 3 dimensions. The first one is the global reinsurance market. So insurance is connected into the global system via the reinsurance market. We underwrite the risk at the African Risk Capacity. We aggregate it onto our balance sheet. we retain the level of risk that our capital allows us to retain, and we pass on the rest of the risk to the global reinsurance markets, meaning that when there is a claim, part of the funding to pay for this event comes from the global reinsurance markets. And the market is by definition a global market. So taking into account the risks, in the Caribbean, in the US, in Europe, in Asia, also thereby improving diversification. And of course, since we have economists on the line, based on the capital asset pricing model, right, the more diversified you are, the lower your cost of capital is going to be intuitively. The second role of crowding in finance comes from having a blended finance capital structure, whereby we are able to have in our capital structure really concessional capital, either through grants or through deeply subordinated debt that's not looking for a financial return. So we have in our capital structure, as an example, interest-free loans from KfW in Germany, from FCDO, in addition to grant financing from USAID and the Swiss Development Corporation. Then this is then also mixed with the more return-seeking capital from the reinsurance markets. Having this blended capital structure also lowers our cost of financing, meaning that we can offer our insurance product more competitively. And this is important because then the lower the pricing is on our product, the more people can afford it. The more people can afford it, the greater scale we have and the more diversified we are, really building this virtuous cycle. Then the third element of crowding in finance is around catalyzing the market. Most of our insurance programs are subsidized in one way or the other by multilateral donors, by development financial institutions, by governments to some degree, meaning that the cost of the product is actually lower than what the end user is paying to access the product. Then on the role of insurance, actually, as you rightly say, Jennifer, the insurance has a huge role to play, again, on 3 dimensions. Firstly, insurance is really about analyzing data and calculating the level of risk. So the fact that we're able to quantify the level of risk, I think, really focuses people's minds because when you look at investment in mitigation, it can then be tied to the amount of insurance premiums that you are paying, because the insurance premiums give you a very good indication of the level of risk associated with any activity. Secondly, we have risk management expertise, since we operate on a continent-wide basis. And again, this data is extremely useful to all the players in the market. The third aspect, which is not really talked about as much or understood as much, is that as insurance companies, we have quite large balance sheets. In fact, insurance companies are the largest institutional investors globally. So the way we allocate our own balance sheet means that we can prioritize, climate mitigation and adaptation, responsible investment principles as well, including, financing renewable energy products, projects where appropriate. Then on the African continent, if insurance is so wonderful, why isn't everyone using it? 2 main barriers exist. The first one is around knowledge of insurance. So generally, the insurance penetration in Africa is low because not everyone knows or understands or indeed can access insurance programs. The second big issue is what I've already mentioned around affordability of insurance premiums. At the level of countries, ministers of finance have to make the difficult trade-off between putting medications in hospitals, paying for infrastructure projects versus buying insurance, because African countries are not cash rich. So then, which is why I was mentioning the importance of subsidization in the insurance programs, because then this lowers the price point of insurance. That said, though, this is not a speech to say that the battle has been won, but we are making significant progress, because at the African Risk Capacity, we're now providing insurance to about 50 million people per year on the African continent. And this has grown, at the rate of 20-30% per year for the last 5 or 6 years. So at this pace, there's still a long way to go to cover the 700 million people that actually need insurance. But we're also making steady progress with the support, of many people that are on the call today. So I will stop here, and of course, happy to expand and to take any questions later on. Thank you.
Great. Thanks a lot, Leslie. And I mean, I think ARC Limited and ARC in general does represent a good example of how DFI money can be crowded in for, sort of innovative finance mechanisms. Not enough, I agree. But that's the place, and you did hear, a number of the bilateral donors have understood that this is a really valuable way to try to have catalytic impact, because that's what it is. I just wanted to say one thing also, just to, because you talked a bit about subsidies. I think, and even myself, when I first started looking at these issues, I was like, oh, but eventually they should pay themselves, because, if you value something, you'll pay for it. And the reality is, if you look globally at how insurance, farmer climate insurance is paid for in rich countries, these guys get huge subsidies, at least 50%, and usually a lot more. So the idea that somehow African farmers or South Asian farmers should, completely pay the bill themselves in these bundled, products without any support is putting the bar much higher than in the US, in Japan, in the European Union. And that's just something that we have to really understand. This is something that is always subsidized by governments, but the governments in these countries just don't have the same finances. So I just wanted to make a plug for that, because it's also a learning that I had at some point that I think people don't realize. So thanks a lot for that. And I think it's a good segue back to you, Simon, and let's try to be a little bit more positive. I mean, the question I sort of have for you is, given what we've heard, is everything sort of stacked against these farmers to try to, do what they need to do? And I also know that you've worked, a bit with Leslie, and you guys also have a program on insurance in particular, but, how bad is it? And, you're such an eternal optimist. I hope you're going to turn this around and give us a bit of positivity.
Yes. So thank you for that. And the challenges are serious, and the challenges are growing, as we're hearing from everybody. But I also think that we are at a moment where there is a realization, as Brendusa was saying, that we don't have the solutions yet, and this creates this sort of sense of a perhaps pending crisis. Actually, I think creates an opportunity then. So yeah, putting the optimist hat on, what are some of the elements then of helping to address improving the markets, the financial markets, food markets for smallholder farmers from a financing perspective? First of all, we need to recognize that, as I said earlier, microfinance is not the solution for all of the challenges, but it has a role to play. We need to recognize that local banks, and I fully agree with what Dominic said, these solutions are going to have to be found primarily in the local markets for all the reasons he mentioned. But local banks by themselves are not going to solve the problem, but they do want to find better ways to lend at lower risk, and are often coming under pressure from their central banks or investors to do that as well. And we also need to recognize that the development and climate finance space is also wanting to lean in more productively. So the question then is, how do we do that? And what we're thinking about, and we're working on this with friends at the Milken Institute at the moment, is what we're starting to call system finance. So even the kind of blended finance solutions that Leslie's alluding to and Bendusa was talking about, they still are typically focused on a particular transaction, and then bringing in these different kinds of de-risking and credit subsidized layers and so on into that. But what we actually need is to look at a solution which may well have multiple transactions within it. So let me give you an example from Bangladesh that we're working on right now with BRAC. We want smallholder farmers to adopt more water efficient, lower methane rice production technologies, what is called alternating wetting and drying. This can be driven as a behavior change initiative on its own. It's just a change in practice. But the reality is that smallholder farmers don't adopt this because if they only do the change in practice, they get more weeds. And if they get more weeds, they either then have to spend more labor time weeding or they have to buy herbicides, and they're not making any more money. But if you take a bundled solution and you say what the farmers need is to diversify their farms and grow a cash crop or vegetables or something where they can earn more money because the land is actually easier now to grow other things on because it's not flooded for so much of the time, then they can use some of that increased revenue to then invest in improved technologies on the rice production, which then enables them to increase their productivity in rice, make more money out of the rice as well, and they're fundamentally better off as a result. In order to enable that to happen, we need the farmers to be able to access finance. We need the off-takers to access finance to buy from the farmers. We need equipment suppliers because the farmers will need to actually acquire machinery services, for example. So the machinery needs financing and so on as well. So starting to put it all together and saying, actually, we have a coordination and information asymmetry challenge that can be solved with a coordinated or systemic approach to this. And then you bring the insurance in, for example, as a part of that bundle. Then you can start to do all sorts of offsetting in terms of, well, which piece is getting, which return, which piece is getting de-risked in which way. Where does, for example, technical assistance then and capacity building need to come in? How does that get funded and so on? So we start to take this idea of then capturing economies of scale by doing this at a very large scale. We get value chain players and off-takers to commit because they have scope 3 emission reduction targets that can be satisfied, for example, through this kind of intervention. We get finance for the first mile. The entrepreneurs are actually going to work with the farmers as part of that. We mitigate the risks through a combination of insurance, guarantees, first loss facilities, etc. And smart subsidies come in to underpin the affordability questions. And what we're trying to solve for then right now is how do you do that system finance coordination? Who's going to be the, let's say, natural owner of that coordination piece? And maybe that needs something like, Dominic, what you're running to come in into this space of climate adaptation and climate mitigation finance for smallholder farmers. And we need to set up some special vehicles or incentivize an existing institution, perhaps that has part of the capabilities to step forward and say, we actually want to take on this system coordination financing role. So we're going to be holding a workshop on December the 5th in Abu Dhabi alongside COP28 to look at this problem closely. And this is something that we will then want to really get into our stride about going into next year. So happy to discuss or hear from others who might be interested in exploring this further with us. Thanks, Jennifer.
Great. Thanks a lot for that, Simon. And I think, there it's really that whole question about looking at the whole value chain. And I'm glad that you raised the issue of risk because we've kind of long understood that. It's a lot easier to provide guarantees if you know what's going on across the value chain, sort of like a company that would be vertically integrated. And by the way, when insurance is part of it, or even just when you know what's going on, you talked about the scope 3 emissions, which everybody's kind of trying to figure out, how am I going to do that? The data from the insurance sector, but more generally, is also incredibly important for knowing what's still insurable, what's not insurable, and just pricing that risk. So that will be incredibly important going forward, and an area of, I think, collaboration between a couple of you. So with that, I mean, Dominic, let me come back to you and talk a little bit about market incentives, right? You talked about the sanitation and hygiene economy. How do markets actually, like, how do you imagine that markets could actually make that work well, right? These should be good jobs. These should be like businesses that are generating employment and revenue and providing a service that people don't have right now, and a good service, and ideally a more sustainable service than you have in advanced economies, because you sort of have a second mover advantage, right? And also, you know, you mentioned menstrual health and hygiene, and we know that this is a huge issue. Can you tell us just a little bit also about how you approach that, also from a market approach, but, you know, the benefits of? So back to you, Dominic.
Thanks. Can I just check that you're seeing a screen with sanitation hygiene?
Yes, we
fund
do.
on now? Yeah. Is it red or is it white?
It's white.
It's white. Okay, because just checking we've got the right one. Thanks, Jennifer. So look, as we've talked about, you know, how we value things, obviously the means of delivering that is through what we describe as two ways. One is the sanitation economy, the other is a menstrual hygiene marketplace, to try and understand how we support the value chains in that. And I'm going to resort to using a couple of slides to try and illustrate this. And I've also put a link in the chat to the book on our approach on menstrual hygiene. Let's just see if this works. So these are the two core documents for us. One is our strategy. The one on the right is Power in Our Hands, which describes the market-based approach. But in a nutshell, just talking about the sanitation economy and the value chain, as we started to explore, you know, how to engage in the sanitation economy, actually what we learned is critical is market maturity. That's not to say, you know, a highly mature market is good, a weak market is bad. It's just really understanding that in this situation, context is critical. And when you're designing the interventions, you really need to understand what are the dynamics in the marketplace. I just put here, this isn't necessarily the marketplace, this is the value chain for sanitation, but as you can understand, you know, in each situation, in each country we've looked at, the regulations are different. Some of the regulations are very positive for investment. Some of them are very weak for investment. In sanitation, for example, you know, companies and SMEs need to know that they have a revenue stream. Where does that come from? That will come typically from a concession with a form of guaranteed payment, partially from the government and partially from the users. So and each context is different. So what we've spent a lot of time doing, and we are still doing it, because actually there's very weak information on market maturity and market analysis. It's something we're embarking on now, so that we can, on a continuum of very advanced to not advanced at all, we will be able to put each of our partner countries on there and help them understand how can they graduate up that scale to improve the chances of making their market investable. That's ultimately what we're trying to achieve. And Brundusa talks about that, Simon as well. And Leslie talked about the risk profile. We're trying to make the sanitation economy, which exists everywhere, but trying to make it more investable and more accessible. In the same way, we're trying to do the same with what we describe as a menstrual hygiene marketplace. This is a gross simplification of the approach, but it just gives colleagues on the call an idea of how we're approaching it. So there are literally hundreds of thousands of women, girls, and menstruators who do not have access to menstrual products, and this is, in our view, a failure in the market. And we believe that we can incentivize SMEs and others to fill in this supply chain gap. We have actually spoken to many of the big corporates. They're not interested because these markets aren't mature enough for them to get the sort of return profile that they're expecting. So in many ways, we are looking at the most risky markets, but where there is still a huge unmet demand. And this approach here of market readiness, market building, and market acceleration, Simon's probably looking at this saying, but we do the same in ag. You can look at it and say, well, we do the same in energy. We aren't suggesting a brand new approach to market shaping and market development. We're saying we just need to learn about this in other development sectors, in sanitation and in menstrual hygiene, and to bring those lessons to bear so that we can help the governments, the key stakeholders, the regulators, but also the financial institutions and local banks understand what the market is, where the risks are, what the potential revenue streams are, and to understand a good business proposition when somebody comes along and asks for financing. This is the approach. I won't go into that, but again, Simon and anybody else on the call who is working in this catalytic financing space will say, well, that's already what we're doing in other sectors. We just need to bring that experience to bear. But in particular, it's about understanding or helping people, financiers in particular, to understand what are the expected financial returns, what are the risk profiles in these markets, and how do we match those two? And in order to do that, we need to bring impact to the fore. We need to be able to explain, verify that impact in the same way we do in carbon financing and in other forms of social impact bonds, etc. We need to be much more rigorous about being able to articulate those and the externalities, as we've talked about. A lot of the work we're doing, Jennifer, as you know, is around what we describe as pipeline development. So it's that part of the equation of where are the investable opportunities in the market. In many of the partner countries we're working in, we've looked at, there is no investable pipeline. There are people operating who, with the right support and the right incubation, could become investable opportunities, but a single SME in a single country is not a marketplace. So we know that we have to shape economies and the menstrual hygiene marketplaces at definitely the national level. If you talk about India, you can perhaps do it at a state level or county level, where you're still talking millions of people, but you need that the base level of demand to make the economic equations work. But so our focus is around shaping the markets to make sure that and to help them become more mature, and to help everybody understand what their role is, what the government role is, what the private sector role is, what the financing role is, to make it easier to finance, not to necessarily make it profitable in a way that is suddenly going to see a gold rush of investors. It's not that type of approach, but where people can see there's an extremely positive social impact here and an acceptable financial return. The biggest gap, I think, in all of this, there are three things. The first one is data. The second one is data. The third one is data. Data is key. Data is a risk reduction process in itself. That we're assuming that the markets are not mature, but we're not able to verify that and to put people onto this spectrum. That's what we're working on. We're talking to colleagues in Geneva, for example. We're talking to CERN and how we can make use of their massive computing capability to start churning some of the data that's out there, and hopefully we'll get more data. But that is what is going to drive these investable opportunities, when we're able to quantify and to put them into investable propositions that people are willing to finance.
Thanks a lot, Dominic. And I would just reinforce the development impact. The number of days of school, of work that are missed by women and girls because of this is just extraordinary. That's the first thing. The other thing is the climate impact. I think you mentioned it, but really just to reinforce, in advanced economies, the number of menstrual hygiene products that end up in landfill and create all kinds of, emissions and are terrible just on a pollution and a climate basis. These are things that, I think this is an opportunity. Also, I don't know if you call it frugal innovation, but to learn how to do things better with more sustainable products, and then maybe even, transfer them, sort of like mobile banking or whatever, from the emerging world to advanced economies. And I love data. So when we talk data, Leslie, I'm coming back to you. You know, because I mean, you're running a data-driven business. I mean, it's 100%. That's what you do. And so, but I mean, when you think about it, how could you actually create a thriving climate insurance market in Africa? I know you're working towards this, but you know, so what are the sort of next steps?
Thank you very much. So I also really like the data, because that's really the challenge that we're faced with. So then to start by just sketching how our insurance programs work, we use parametric insurance. So we're able to model what the expected impact of a severe weather event is. So if you use a peril like drought is a function of not having enough rain in a particular location. The amount of rainfall in any particular location can be accurately measured using satellites to generate satellite data. Then on the basis of that, you can correlate the amount of rainfall in that area with crop yields. And this is a stable science, and it's something that's been done, you know, for the past 40 or 50 years. This approach of using a data-driven model has two major advantages. Firstly, it's hyper scalable because we don't need to have boots on the ground in every location. As long as we have access to the data, we can calibrate the risk and we can design an insurance product. So which means that we could simultaneously launch insurance products really all across the African continent. The data that we use is usually available on websites, you know, such as NOAA in the US. There are a couple of universities that also produce really good data. The Europeans through Copernicus and Temsat also produce a lot of data. So then anyone that's using our products can go on the websites, download the data, and reproduce the calculations that we are using. So it's extremely transparent. Then the next advantage is just the speed of payout. So you don't have to email us or to write us a letter to let us know that there's been a drought in your area. Since we have real-time access to the data, we know when an insured event has happened, and we pay a claim usually 2 or 3 days after the event has happened. We can't pay the claims any faster because then we still need to go through the KYC and the verification. But really, it's quite fast in terms of getting money into the hands of people that need it. So this whole system works on having accurate and reliable data so that the clients have confidence in it, and our reinsurance and capital providers also have confidence in it. It's a chicken and egg problem in the sense that to get good data, you need to have a lot of users, and to get a lot of users, you need to get good data. But in general, it moves in the right direction. You know, we've been in operation for the past 10 years, and the quality of data has grown in leaps and bounds. There is a lot more that still needs to be done, which is, I guess, is a recurring theme of the discussion. But as it stands now, I think we are at a point where we have products that are reliable enough with the data that we have, while we make progress towards getting even better data. Thank you.
Excellent. Thank you so much, Leslie. And I think that also offers some hope. I think it's a positive final, you know, kind of thought among the group in terms of the comments, because I think, you know, when you have the data, at least you understand what's going on. You know, like open the window, at least you know if it's raining or not, right? So I mean, this is an area also, I think, that is very compelling for development finance as well, because we do need to know where we're standing, and that's true for everybody also. You know, all the climate finance models are really required to understand what's actually happening. So with that, there were just a couple of questions in the chat, and I want to give each of you just like 30 seconds, because I know we've sort of run out of time. If you want to just say where, I mean, in particular, Dominic and Les, there's questions in the Q&A about how can they engage with your institutions, and also Certainly, Simon, I'm sure that people have the same question for you. So could I just maybe let each of you, give each of you like a minute, just that we can get everybody on their day. And I know each of you have things to do, just for any last comments, and also to sort of reply to what is needed, or how they can get in touch with you.
I answered in the chat, Jennifer. If colleagues want to have a look, I've put written answers in. But obviously, people probably best for people to collect through LinkedIn. That's the best way to get a hold of them.
Okay, so to get in touch with you through LinkedIn. And any last word of wisdom in 10 seconds?
Oh, yeah, we need, if you're, you know, for economic ideas, please think laterally differently, as open as possible, challenge the system. We need, you know, innovation in how we finance and how we value development. Okay, Leslie, I'll go to you.
So it's about building scale into the solutions that already exist. They only work at scale. Thanks.
Great, thanks. And Simon, last word.
From my side, it's about collective action, that we need to come together, bringing the different elements that we all have, and then creating structures where we can all see ourselves gaining by the merits and benefits of that collective action.
Great, thanks so much. And I would add to that, breaking down the silos between the work that you guys do, right, which are all incredibly complementary, and that's the kind of, you know, will lead, when you have progress in all, right, then you will have, you know, progress for everyone. So so I think that's a perfect way to end. Thank you guys all so much for an amazing discussion, and I know that this will be shared, and I think next week Paul told me that, you know, we'll be able to share this more broadly, so that many more people can benefit from your words of wisdom, and I've very much enjoyed and learned from this discussion. Paul, with that, can I hand it back to you to tell us what is next?
Definitely. Thank you very much, Jennifer. That was a very insightful conversation that we just had. We're so much grateful to you, the moderator, of course, to all our panelists, Dominic, Leslie, and of course, Simon and producer who joined earlier. We are so much grateful for the time that you spent with us and the insight that we've shared. As we mentioned earlier, this session has been recorded, so in the coming days, we'll make it available on our YouTube channel, and we'll share with our panelists, of course, to all the people that join as well. So all too soon, we're coming to the end of GEIF 2023. We have our last and of course final session happening in about 40 minutes time, which is 13 CET, which is going to focus on the BRICS and of course or issues regarding developing economies of countries in the global south. So it promises very insightful. So hoping that all those that have joined will also be able to join us for that session. So until then, we say a big thank you to all of you for making the time for the session. Yeah. Okay.
Thank you.
Okay.
Bye.
Bye.
See you in a bit.
Okay.